Hello traders, Gary Wagner here, just about 11:30 in Honolulu, 5:30 in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is the 21st day of August, 2020, and this is the Daily Report for Gold and Silver, our weekend review. We have seen the market sell off dramatically over the last, call it 10 trading days. We are seeing some signs of a slowing of the descent, but I do believe that we could still see more selling next week. We'll have to see how that unfolds, but we had interesting action, really muted action in the markets today. We'll talk about our targets in terms of where we're looking to get in when we look at our charts, but first to the price board. Another mixed day in the precious metals markets, with gold futures closing slightly higher, as you can see, up 90 cents at $1947.40. And that, of course, is basis the most active December contract. However, silver, on the other hand, declined by almost a full percentage point, drawdown of about 26 cents, and that market is currently fixed at 26.88 cents. Now, a lot of it had to do with dollar strength. The dollar index was up about 0.45%, 93.20, and you can see this small green candle down here. That is indicating, this is on a weekly basis, that we have had a slight move to the upside after hitting a lower low earlier this week. In terms of the two electronically traded funds that we have been involved in, we have the iShares Silver Trust at $24.90. Continue to maintain your stop at $22.98. The low today was $24.42, so we are in good shape there. And lastly, GLD. GLD is at $182.03. We have a stop at $178.66, so we are also still long those two electronically traded funds. Let's take a look at our technical studies. Throughout this entire week, we have been looking at possible price points where we thought would be a logical spot to look for where this correction could conclude. The primary method that we were using was based upon Elliott wave and Fibonacci retracement. In essence, what we were doing was measuring the length of this long rally here. We're calling this a wave 3, and then plotting various levels, 23 and 38%. And what we said was that if we saw the market have what is called a flat, and a flat is simply where you get your first A wave right here, your B wave, which comes in between 50 and 75% that of A. We know we met that criteria. And then the selling pressure ceases once you get an equal low. In other words, these two lows match. We talked about looking at the market in that way. Today, I want to look at another set of technical indicators that are really in agreement with the different points that we have looked at. And what I am talking about specifically is the 50-day, 100, and 200-day moving average. The first thing that we have to notice is that they are in perfect alignment for an absolutely bullish market. In other words, the shortest term, the 50, which is in green, is on the top. That is followed by the 100-day, which is below it, and then the 200-day, which is below that. That is what you want to see. The other thing that you want to see when you're looking at sets of moving averages of different lengths in a bullish market is you want to see these areas widen between the 50 and 100, of course, and between the 100 and 200. We're certainly getting that. But what I find most fascinating is if we extend this particular 50-day moving average up, it's coming in at 1872. 1872 is roughly the area where we had this low in right here, just about a couple of dollars away. And what that tells me is that there is a high likelihood that if we do see continuation in selling, it will cease at approximately 1880. Now, it could go lower, and we talked about a couple of different numbers, but the 100-day would be the next logical area using this technique, and personally I don't think it will go that deep. However, there's a caveat there, and the caveat is if we look at this particular band right here where the 100-day exists, we can see a couple of things. One, we can see real points when it acted as real resistance. We can then also see when it kind of flipped above it, then it began to act as support. And it was really the bouncing board that came and broke above the 100-day and took us to these all-time new record highs. That being said, we will remain flat over the weekend with no active trades in gold or silver futures, as well as Forex gold or silver. We will maintain our current long position and our current stop in both ETFs, GLD, and SLV. And traders, there is another technical indicator that is signaling that at least the speed at which this correction has been declining in price is definitely starting to slow down. We can see that through these Japanese average or Henkin Ashi charts. The key difference between this and a candlestick chart is the open is fixed on the midpoint of the prior day. And that's why when you get these solid rallies, you see the absence of lower wicks, and you also get pretty nice body sizes. You also see real clear pivots as the market changes direction, such as here. First, you got a small green candle, then you got the pivotal red candle. That's when we saw the correction come in. It tried to recoup. We went again, here's our little pivot right here. It went up 2 days and now is going down. But what we are seeing is even though there is the absence of these upper wicks, and that's what you want to look for in a market that is in a declining scenario, because once you see that, it's telling you it might be coming to an end. But look at the body size. It continues to contract, and that tells me we're slowing down. So whether or not we actually reach this target is something we'll have to see over the next week. It is a logical point, but realize this is a market that's going to trade the way it wants to trade based upon fundamental events as they unfold. And I was once told a story by Larry Williams who said that as a market technician, we are simply sitting at the end of a boat and we are looking at the wake that the propellers cause as it goes through the water. And as the boat turns, of course, we see a shift in the wake, but only the captain knows when he's going to turn the wheel. In other words, when a fundamental event comes, we are not in the captain's seat, so it will be something we see later that will lag behind in terms of a technical reflection. The fundamentals will always come first. And traders, lastly, I do want to take a look at silver. There's a couple of things that are absolutely noteworthy. One, there's a difference between the way we have seen the three moving averages react. I'm talking about the 50, the 100, and 200. You can see that most recently we had the 100 cross above the 200. They are now in alignment. They are moving apart. But if you look historically, you can see that as it moves sideways, you have these markets kind of crisscrossing into each other. The second thing that's very evident to me is that we have had an extreme compression of range. When we take a look at these series of highs that come in, we have a series of lower highs, we have a series of higher lows. That is a compression triangle. Typically, what we look for in this type of formation is as it approaches the apex, it is building an energy. When it reaches the apex, the energy is released and you get a sizable break either to the upside or downside. However, in many cases, if not the majority of cases, you will get the break to the prevalent trend direction, which we certainly would say is up. In other words, I believe that once we move out of this compression triangle, we're going to get a sizable break to the upside in silver. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.